Alright, what's going on, everybody here? Economics 101 here. Thanks for tuning in to my first video. So in this video, we're going to talk about money creation and banking system. We're going to be covering two topics today. How money is created and how it starts to circulate in the economy. So in the monetary policies of modern times, which is it's have been around since basically for a couple hundred years now. The system, or about 150 years, it's been the same system that's going on, and it still exists today. So it's called. There's many ways that the what do you call it? The money actually starts to circulate in the economy, which is through fractional reserve banking, central banking, and so on. But we're just gonna look at how it actually how it's created. I'm not gonna go into details or anything because it can get really complicated. But how money's created, I'm gonna use the Federal Reserve Bank as my model here, which is located in the U.S. It was founded in 1913, and what the Federal Reserve is, it's basically a central bank. And what a central bank means is just one central bank that's allowed to print money, which is actually it's not money is not the proper name of the money we use. It's actually called fiat currency. And what fiat currency means is that simply any institution can monopolize the currency itself. So the institution, which is a central bank, can print money whenever it pleases without having any physical backage of it. So it wouldn't use gold or silver just to back up the money or anything. It's literally pieces of paper, and mostly actually digits on the screen, because 97% of the money in circulation actually exists digitally, not physically. So anyway here, so yeah, the central bank is literally like the kind of like the heart, literally the heart of all the banks. It's also the brain too, because it decides how the banks acts. It monopolizes and manipulates their decisions. It actually manipulates every, especially investors' decisions too, and so on. So anyway, we're gonna start with our first topic here: how money is created. So the central bank, what it would do is that it would start by printing money. It would print money because it's a fiat currency. It does not require any silver or gold or anything to back it up. It can print it whenever it pleases. No, now the central banks around the world, actually, they're not part of the government. They're actually an independent entity, and no other entity can overrule what they do or what they say or what they want to do. But I'm sure there's some extent to that. I'm sure if it comes down to it, the government would probably be able to control the Fed if it was really going against the economy and the government and so on. But for now, it's an independent entity. That's what they call themselves. So in the economy, again, I'm going to use the U.S. here as my model. In the economy, what would happen is, let's say we want to print money. So how do we do that? Um, the central bank is the only entity that is allowed to print more money to circulate in the economy. If you and I do it, or any of the other banks do it, we would go to jail. The government is not allowed. Nobody's allowed. It's only the central bank, which is the Federal Reserve in the U.S. So it would start by printing money, and then it would eventually loan it to banks or the government with interest. And what interest is, it's basically it's more money that you have to pay than what you owe, than what you loaned. Um, so what would happen is the central bank would start to let's say it would give a loan to the government, and then the government would use this money to inject it in the economy. How do they inject it in the economy? They would start by new projects. They would pay their employees and so on, and then the employees would use this money to even create more money in the economy by going and buying stuff, and the money starts to circulate and so on. And then these people, one day, they're gonna want to buy houses and so on, and you eventually get loans to do whatever they want. So what they would do is they would go to banks, and the banks would give them loans with interest, And then those same banks actually did not create the money or anything. Well, actually, they did through a system called fractional reserve banking. But I think I'm just gonna leave this for another video since I'm not trying to keep. I'm just trying to keep this video under 10 minutes. Um, so the banks would basically loan out to would they would loan money to the people and so on. But the banks did not create the money. They actually they got the money from the central bank. They got the money from the central bank. Now the central bank, all the loans it gives out, they mostly have interest on them. They um, they mostly have interest on them, and so which is actually the main reason why the U.S. is in so much debt. The government, 20 over $20 trillion, is because of all the interest that's used upon the money, and there's no, like, I don't care what anyone says, I don't care what politician says. There's absolutely no way they can pay that money because it simply does not exist. It simply does not exist. And actually, by the way, the more the U.S. in debt is, the better for the economy because the more debt it is in, the more growth it is there's on and so on. Except if there's hyperinflation or any of that. Anyway, here so yeah, we're gonna stay on topic here and move on. So we understand that how the money is created now, what interest is, and how it circulates, and I'm gonna now talk about how it circulates in the economy, which I kind of touched on a little bit. But yeah, so the people would try to get loans from the banks, and then the banks are actually the loans that the banks got from the central bank. But there is another way for them to get money, which is through the Federal Reserve funds rate, which simply means is that the banks would loan to each other money. So they're not using the Fed anymore to get the money. No, they're actually using themselves to trade money with each other. Now the federal funds rate, there's interest that's yeah. So the reason why there's interest because nobody's gonna loan you money without getting profit off of it. Yeah, the banks might be rich, the banks might have a lot of money, but they're not just gonna give you money to get nothing out of it. This is not the capitalist system that we live in. Everything you must do has to profit you. You have to get something out of it for you to do it. So that's why simply the interest exists because you profit. You can make huge profits off interest even with low interest because you give out if you give out so much money, if you give out $1 trillion with like 1% interest, you probably end up with like a 10 million or $100 million just in interest back. So so yeah, the federal funds rate is actually controlled by the Federal Reserve, which is the central bank of the U.S. So it actually controls, but however, in the federal funds rate, it's usually lower. You get a better deal. Like the banks would get a better deal, will get a better loan with lower interest if they loan from other banks, than if they loan it from the central bank itself. So it kind of manipulates how the economy is going and so on. So yeah, I think that's gonna be it for today. If you have any questions or anything, please leave me a comment below, and I will definitely answer you. Thanks for tuning in, guys, and have a great day.